This is the Rodney Bull Show, bringing you truth about money they never taught you. Now, here's your host, the man himself, Rodney Bull.
G'day, and what's cracking, legends? Welcome back to the Rodney Bull Show. Today's guest is someone who's taken a very different path to building wealth, and it's one of that challenges a lot of what we've been told about money. Lane Kawaoka started out as a civil engineer, doing what most people are told to do: study hard, get a good job, and follow the traditional path. But early on, he realised that something just wasn't adding up. So instead of relying on the usual 401ks and stock market strategies, Lane shifted his focus towards cash flow real estate and never looked back. So fast forward to today, Lane. He controls over 10,000 rental units, representing more than $2.1 billion in real estate. That's a hell of an achievement, if you ask me. And has helped investors deploy over 200 million into real world assets. He's a 3-time Amazon best-selling author, host of a top investing podcast himself, and a strong voice for moving away from Wall Street thinking, which I'm a big advocate for myself too, toward building real cash flow driven wealth on Main Street. What I like about Lane's system is this: he's not about flipping houses or chasing hype. He's about building passive income, long-term systems, and financial freedom that actually last. So if you want a real good understanding about how professionals and good hard-working people can go about doing this, this is a good one for you today, people. Lane, welcome to the show, mate.
Yeah, thanks for having me, Rodney. Hello, everybody.
It's a real pleasure to have on, mate. Appreciate you giving us your time today. I imagine you're a very busy man doing what you got going on in your world with all of that sort of stuff happening.
Yeah, no problem, no problem. But yeah, like you said, the people got to hear about this stuff, right?
Yeah, mate, for sure, definitely. So we'll just get into it, Lane. You started out as an engineer, doing everything right and good job and steady path and ticking all the boxes, mate. But at some point you realised that it wasn't actually leading you in the right financial direction, mate. So what was the moment that you saw clearly decided to step off the traditional path that was taking you nowhere good?
Yeah, I mean, I'm good at math, right? And if you do the math, if you do it the traditional way, you buy a house to live in, you do what you can in the 401k, maybe you could step away in 40, 50 years, but
Yeah,
you're going to pay a lot of taxes, especially at the end, right? It's what they don't tell you about the 401k. You defer that all to the end when your income is the highest, which is kind of ironic.
yeah,
So I I bought a house to live in, just like how we're all taught to do, right? And
yeah.
I was kind of lucky because I originally worked for the railroad, and
Okay.
I was never home, and I just kind of on a whim decided to rent this house that I bought in 2009 out, and because I was a single guy back then, and this is well before like the days of Turo and Airbnb. And I just kind of thought it was wasteful for me to have this big house to myself. So I called up an old landlord or property manager. I didn't even know the difference at the time. And we got a tenant in there, and I was cash flowing, right?
Sweet.
I think the first month it was like $2,200 a month rent. And then my mortgage was like $1,600. So for a young 20-something-year-old kid back then, that was a lot of beer money,
Oh
right?
yeah.
And so I did that for a few months, and I was like, wait a minute. I should probably get serious about this thing, right? Because if I just kept rinse, washing, repeating, putting down more 20% down payments, I don't know how much it is in Australia where people are at, but in America, you can get pretty good financing if you got good credit and a good paying job, and just save up for the down payments and keep doing it again and again.
Yeah. Yeah. Here in Australia, it depends on where you're buying, whether you're buying in a big town or a city as opposed to buying rural, dictates terms on the percentage that you got to put down as a deposit. But in the cities and that they can do 5 or 10%, 15%. And if you get out into rural areas, it can be 20% or more than that. If you want to buy acreage, you're looking at 50% for acreage.
Wow. Yeah, that's interesting. A little bit different
Yeah,
out
a little
there,
bit
but
different, and we don't have like 30-year mortgages like you do, like as in you can lock in for that long. We have 30-year mortgages as such, but like the maximum length of time that we can lock in on a fixed interest rate is like 3 to 5 years. So there's a fair sort of difference there between what I believe you fellas can do, lock in for the whole 30 years on a fixed interest rate, can't you?
Yeah, yeah. So, with us, it's a little bit, financing is definitely a little bit better. I think the government subsidizes that with Fannie Mae, Freddie Mac, but
Yep, yep.
I
Yeah,
mean, it is what it is, right? Get you started, and that's kind of where I just started to focus on, every 30, 50 grand I saved up, I could kind of put it to a down payment on another property. And fast forward a handful of years, 2015, I had 11 of these little rental properties. It wasn't all sunshine and rainbows, maybe, a few $100 of cash flow per each, but definitely had like, an eviction or two every single year, some kind of big catastrophe that happened every quarter. But, it definitely eats into profits. But,
yeah.
it came a nice little like third paycheck every
Well,
single month as I was still working my engineering job.
yeah, for sure, mate, for sure. So, like you just said, it's not all rainbows, along the way with having getting into them investment properties, dealing with tenants and good tenants, bad tenants. Obviously, you're trying to look for good tenants, good paying tenants, and long term tenants. So, I guess that's something that you've got to factor into it as you're going, mate.
Yeah, exactly. I mean, that's where I've always said like, utilize third-party property managers because that's their job is to vet the people coming in, and you're kind of leveraging their experience on, you can't vet everybody yourself, right? At some point you have to rely on other people's experience.
Yeah,
Although they do say like, check out their car, right? The way they keep their car is typically the way they'll keep their
yeah,
house. But,
good
I
indicator.
was buying all these properties sort of sight unseen, and I was in Seattle, Washington at the time, buying properties like thousands of miles away in Alabama, Indianapolis, places like that.
Okay. So, were you doing the research into them yourself, Lane, to find and do all the due diligence into them, or you had yourself someone doing that side of it for you, mate, and then you were just going over what information they provided to you?
Yeah, I mean, I did the research generally from the market level. Like one of the criteria we still use today is we tend to invest in more red states. I don't know what colors you guys got out there, but
Yep.
like when you're the landlord, you kind of want the landlord laws on your side. Certain
Yep.
states are a little bit more friendly to the tenants, which I mean, I live in a blue state, but to me, if you don't pay your rent, you can't stay. That's not how all the states work out there.
Yeah.
And then, you got job growth, rent growth, these are very attainable statistics out there. They're a little bit delayed, of course, right? But these are the typical drivers of what makes a good market to invest in. And, you mentioned earlier, like investing in the cities and rural. We definitely stay away from like the really sexy markets like your New York, your Los Angeles, your Seattle, because you're just not going to find the rent to value ratios
Yep.
needed to be able to cash flow. And I guess as I mentioned that, like, if if I don't know if you guys have Zillow out there, but if you whatever the equivalent of is, you can take the monthly rents divided by the purchase price, and you're looking for something like 1% in that vicinity. Um, a
Okay.
lot
Yep.
of places that people like to live is going to be, like Los Angeles. You'd be lucky to find a place for 400 grand that rents for 1,500, $2,000 a month. That's less than half percent. That's not going to work.
No. No, you definitely need better rates than that, don't you? To be able to make it
Right.
work for you, proper cash flow. And so, Um, could you explain to the audience what it takes to actually make a property cash flow and what it means to be cash flow positive in an investment property?
Yeah, I mean, you got to buy the right one starting out, right? So a lot of this is just picking the right one from the onset. So what typically means is you can't invest in the real sexy best school districts, the safest areas. You should also stay away from the really rough areas, obviously, right? But
Yeah,
they do think there's a nice little sweet spot in the middle, where you can sort of maximize the rental value ratio, in terms of potential tenant headaches there too.
yeah. So as in being cash flow positive, it needs to cover not only the mortgage payment on the house, it needs to cover landlord's insurance and maintenance and everything on the property like that.
Yeah, yeah. I mean, if people go to my website, they go to thewealthelevator.com/turnkey, they can download a spreadsheet with all these kind of estimates of potential like expenses that they can expect every month. But generally speaking, if you have a property that rents for $1,000 a month, you have maybe 10% go to just stuff breaks, like all the time.
Yeah.
10%
Yeah.
there. 10% goes to your property manager to manage it for you. Be the first person that they call, and they typically play property project manager when something breaks.
Yep.
Another, 10% probably you should put away and for a CapEx rainy day budget. Like the at some point you're going to have to replace the roof every 15, 20 years. You're going to replace the hot water heater, different appliances. And then, you have the insurance, taxes, and some incidentals there too, right? So typically, if you're lucky, if you buy a good property, you may only profit 20% of that at the end of the day. But
Yep.
typically, things always run higher than you think. So, most profit margins are like in the 10% range.
Yep.
Sort of like
Yep.
owning a restaurant in a way, like
Yeah.
very low profit margin.
Yeah. So I guess that's a good reason why you need to obviously keep building the portfolio, mate, and ramp up and scale up.
Yeah, yeah. So like, two, or in my case in 2015, when I had 11 rental properties, that was maybe $3,000 of passive cash flow a month. Not going to complain about that, but most of my clients today who are investment with me, they're typically looking for 10 to $20,000 of passive cash flow a month. So they're going to need maybe 30 to 50 rental properties. And then, you multiply that exception rate, that headache ratio by 5x, right?
Yeah.
And this is where in 2015, I kind of hit a T where, you can't get really in America, you kind of max out on how many loans you can get in your own name.
Okay.
And it just becomes not scalable dealing with all these, 50 tenants, even if you do have property management. More importantly, I think you guys probably would argue that America is the most litigious country in the world. But, when you have that many tenants, just a matter of time till you get eaten alive by frivolous lawsuits that pop up. And that's where I started to interact with other accredited investors and started to learn, these secrets that the wealthy do that I put in my book, The Wealth Elevator, where eventually, you try and get away from being the direct owner of real estate and you invest more passively in a larger syndication or apartment complex,
Okay. Yep.
to get exposure to these types of deals without the legal liability associated.
Okay. Yeah. Sounds good. Sounds pretty involved, mate. I would imagine to branch out from just being in. I'm guessing that the 11 properties or so that you had back in the beginning were just single family homes, were they?
Yeah, yeah, and I think that's where my book kind of breaks it down where, it depends on where you are in the wealth building journey, right? I think a lot of people started where I did. We're good savers of money, so we don't need to read these books on basic personal finance, like how to keep a budget, don't have your Starbucks, save money, right? Like
Yeah, mate.
I was lucky enough to kind of start beyond that. Um, but that's kind of where the Wealth Elevator book picks up is, all right, you got a good paying job and you're able to save. You may only save $5,000 to $10,000 a year, or some people are able to save 50, 100, 200 grand a year, right? But if you're in
Yep.
that category, and especially if your net worth isn't yet to $1 million net worth, to me, the name of the game is buying little rental properties or starting your own business.
Yep.
Of course, my book kind of talks a lot about, once you become an accredited investor, investing in larger deals. But, I think it's all sort of encompassing on, the steps to get there, right? And people always ask, I don't necessarily think this is a good question, but it's like, well, what's your financial tip out there? It's like, well, who are you? Right? Because
Yeah.
all
What's
these
your story? What's your
I mean, they
situation?
were right. Like we're inundated with all these financial tips out there, YouTube Shorts and TikTok.
Oh,
But
yeah.
at what point in the journey, in the which floor of the wealth elevator does this make sense for you?
Yep. For sure, mate. I'm looking forward to getting my hands on your book and having a good read of it, mate, and see what your information you've got to share there from your journey. For sure. Sounds like it'll be some very valuable stuff for people to dig into and start applying to their own situation, because all our own situations are very different to the next person. So you've got to come up with and design a plan that works for you and only for you.
Right, right, right. And I think a lot of it, what we do today too, is we find a lot of accredited investors and we do a lot of events because that's at least that's what really propelled me on my journey when I became an accredited investor and I had 11 rental properties was getting around other people who kind of were on the same level financially.
Yep.
Unfortunately, finances is something you don't really talk about your friends or family about.
No,
You
sadly.
kind of, yeah, you kind of keep it to yourself. I'm kind of the idiot who just goes on a bunch of podcasts and runs my mouth. So I'm kind of broken the seal there for myself. But, traditionally people don't like to talk about this stuff. But, I think
Yeah.
that's kind of where this ecosystem that we've created, we'll do an annual retreat in Hawaii, which is not too far from you. We kind of fill the room with people who are at a certain net worth level and to be able to talk about these things. And what's nice is when we bring people from all over, it's not like people know each other, right? So it's like they're kind of at liberum to speak their mind, right?
Yeah. No, that's a good thing, mate, and put all them different people together, with all them different views and opinions and their mindsets around how to go about doing all this sort of stuff.
Correct, correct, right. And obviously it's a huge subject matter that we work with people on, like, doing due diligence on deals, like, but it's just where do you start, and there's no ending point, right? Like that's why you got to build. We always say, hey, you need to have at least five accredited investor friends to bounce these financial ideas off of each other.
Yep, for sure. So I'm not sure what the difference would be between here in Australia and America, but what is it that gets you to the level of being classified as an accredited investor?
Yeah, I mean it's not really an official marker. I mean, it's just something that our regulators call that, once you hit this pedestal, you have a lot more liberums to invest in private opportunities. But it's just a net worth threshold of $1 million or greater, or if you make over $200,000 US, of course, or greater. I'm sure, a lot of countries I would assume have something similar, right? But
Yeah,
that's kind of why on my wealth elevator construct, like if you're not there yet, you know, just focus on buying assets, whether that's a rental property or stocks. Um, I have my qualms with Wall Street or, the 401k stuff because with that, you're investing in the same things, but you're investing through the secondary market, right? You're kind of getting
yep,
access through the sloppy seconds, as I call it.
yep,
So there's a whole bunch of middlemen in front of you taking your money. Where whenever I invest in a rental property or an apartment, right? Like we invest primary direct to the source. Like we know the people operating the deal and we're direct partners with them. So we're cutting out all these middlemen.
yep,
And that's the thing that's always sort of upset me is the way the investment construct works in America and probably a lot of other countries, maybe even worse, is that the regular people have to work in and take on all the risks, but all these people kind of leech in the middle of the supply chain
yeah.
and essentially white label the same thing.
Yeah, it's not cool, mate, From what I've discovered in my journey, trying to get myself educated around it all. Um,
Yeah,
you're
it's not
just you're
cool,
just
but
getting
that's
robbed. You're just getting
capitalism,
robbed in
right?
fees everywhere you turn. It doesn't matter what you try and get into that side of the world. Same thing here with us in Australia. With our 401ks, we call them a super fund here in Australia. It's our version of what a 401k is for use over there, and it's the same thing, eh? They just eat you alive in fees. Been a lot of people, and me and my partner included, we broke out of that and moved across into a what's called a self-managed super fund, and so that you can be in control of your own money and start
Oh, okay, okay.
start managing it yourself. So and you get to decide what you want to invest it into. So you got to obviously open a business name and everything to be able to do it. So it costs you a couple of grand to get yourself set it up, but um, yeah, I feel it's so much better way of going about doing it and gives you more control of your own money as opposed to just having it go into a super fund or a 401k where some other entity is controlling your money for you and ultimately just chewing it up in fees. And nobody cares about your money as much as you do, mate, and they certainly don't care about your money. All they care about is the fees that they can bleed off you, eh?
Right, right. Yeah, here in America we call it a self-directed 401k or self-directed IRA. So the vernacular is very similar. I imagine it kind of operates the same way. But yeah, but that's it. It's not for everybody, right? Like I think the masses should invest in the normal stuff. Because essentially, you're getting off the beaten path, right? I know you know this, but um, not everybody's able to network and find deals and vet deals on their own. So they should probably just kind of stick on the beaten path. And yeah, you
Yeah,
pay a lot of fees, but it's safer for them there. Where it's kind of like buying a house to live in. Like I don't necessarily think that that's a good idea for a lot of people, especially in our ecosystem. But for most people, it is because it's more of a forced piggy bank, and most people are really bad about saving money, so it kind of
yeah,
forces them to do it. But yeah, it's kind of similarly like most people should kind of stay to their super fund or 401k because they're not very good at investing and finding other network and getting other contact, coming to a retreat and meeting other investors and masterminding over the topic, right? They just invest off the menu, and because that's their level of knowledge, and that's their level of the hobbyist level of interest too.
yeah, yeah, for sure, mate. Like for me, like my biggest thing is that I'm trying to share with myself and my children and everybody else out there that I can share it with is it comes down to financial education, mate, big time. And you've got to go and get that for yourself because it's not shared with us. It's not taught in school, and you don't get it anywhere else unless you go looking for it, eh? And
Yeah,
exactly like you said, without that financial education, you probably are better off staying in that mainstream system, which ultimately won't I don't believe will lead you anywhere good in the long run. You'll work 40 or 50 years and probably not end up in the most fantastic place, and you certainly won't achieve financial freedom.
right. I mean, it's consistently bad, but I
Yep,
think a lot of people they get intimidated by, like, these big institutional companies. Everybody's wearing suits, and they seem to have these fancy algorithms, and they probably do, right? But by paying the fees to them, can you do better by yourself is ultimately the question. And some people they can't. They probably should just, jump on board the bandwagon. Um, but yeah, I think what I started to realize as I started to interact with high net worth people is they did a lot of these strategies that we're alluding to pay less taxes legally, and
that's the
invest in
key, eh?
things that,
That's the big key, that one.
yeah, investing on alternative investments is kind of what we call it. And a lot of these things were very different than what my parents taught me. And but that's I think you got to pair like the ecosystem and the network, right? And I think that's a big part of it. They always say like you are the five people you hang out with most.
Yeah,
And I think that definitely applies to, your net worth is your five people you hang out with most too.
yeah. Yeah, it certainly helps to try and surround yourself with people who are smarter than you as such, and have achieved better things than you at your point in life so far, so that you can gain from them their skill set and their knowledge, and build it into your own.
Right, right.
So, um, what do you reckon? Pretty outspoken about moving away from Wall Street. What do you reckon's broken in the traditional system that people still trust in, mate?
I think I think people don't have examples of people doing it the right way around them. Like, I mean, when I was growing up, my parents weren't accredited. I didn't have a rich uncle, so I kind of haphazardly found this ecosystem. Um, and I actually on purpose seeked people who owned a lot of rental properties. I didn't know what I was looking for though,
Yep.
right? I didn't realize that there was this big world of, very wealthy people very quietly executing all these very similar strategies out there. And I think that's the issue is like a lot of people are out there, they just don't even know what's possible. That's what I wanted to create in my book, The Wealth Elevators, like there's, and to break it down into the levels of the wealth elevator, because as your net worth goes over $3 to $5 million net worth, right, you hit another pedestal where at that point, your investments typically make you more money than you can spend.
Yep.
So people call this zero gravity or financial independence, whatever you want to call it. But you start to have a different mindset. Obviously, you have a different investment and tax strategy at that point. But, I think at this point, you can't just rely on a CPA or, financial planners,
Nah.
and that's another thing. You got to take financial advice from people who are financially free. That said, I am not a financial planner. I'm not giving anybody financial advice.
Me neither,
What
mate.
I'm saying is, think for yourself, but also find other people along the journey that are very similar trajectory as you.
Yep. Yeah. You need to try and find them people who have already done it or are doing it, so that you can learn from what it is that they're doing, and they can help guide you.
That's correct.
Yep, for sure. So you were scaled to over 10,000 units, mate. That's pretty bloody impressive. What changed in your thinking when you went from small deals to large scale investing?
I mean, in the beginning, I thought I needed to have 100% of the grape, but then I realized that if I could just have a little small part of a large, like 300 unit apartment complex, it's the idea of having a portion of the watermelon. Obviously, the quantity on the watermelon is a lot more, but this allowed me to diversify what money I had into many, many assets, and as opposed to being concentrated in just a handful of rental properties and get exposure to different rental markets too, right?
Yep.
I had my 11 rental properties in Atlanta, Birmingham, and Indianapolis, which sounds like diversification, but still it's only a few markets.
Yep. Okay. And you were still just in the one style of rental investment, which was small at that stage, was just personal
Right, right.
housing.
And then I think the cool thing is like when you get to these bigger deals, which you can really start to access when you're an accredited investor or net worth $1 million or greater, is you start to realize like these larger properties are a lot higher quality. I mean, this is why the pros buy these types of assets as opposed to little rental properties on the corner street.
Yep.
Usually that goes to the mom and pop investors, and there's a lot of headache involved with that. But these apartments, obviously a lot more scalable, one roof, multiple people under there, multiple floors, better vendors, more scalable vendors. So I think, many, many reasons why. I'll give you another one. I know some people are landlords out there and they probably, you know, toilet breaks, you gotta call the plumber over. Typically you pay them at least $500,000 to do anything, right? Just, I mean, a lot of that is just their transit costs to come to you.
Yep.
Whereas a large apartment, you typically have a lot of these guys on staff, you pay on salary. They
Okay.
may
Yep.
knock out a little work order before their first smoke break out of the day. I think that's just one example of the cost savings of doing things on a more of a larger scale. But you don't
Yep.
get that until you get above 50 to 100 units.
Yep. Which all in all takes you a little while to get to there, but you got to start somewhere, eh?
Right, right. Yeah. I mean, let's say check out my book, learn about the first floor of the wealth elevator. If you're not there yet, be like me and just keep plugging away at 6 years, the decade, right? But all roads lead to up.
Yep. Yeah. You just got to get your mindset wrapped around it the right way, eh? And just keep going after it. And like you said, just keep surrounding yourself with better and better people who are actually doing what it is that you're aiming to try and achieve.
That's correct.
Yep. Okay, mate. Running short on time here. I don't want to burn up too much of your day on you, but probably just move into one last question if we could, mate. I'm just trying to choose which one. I've got a couple here I'd like to ask you, but I've got to decide which one to run with. um, what do you reckon? What's one hard truth about traditional way people invest, mate, that most people don't want to hear?
I mean, a lot of people, like, I think I already kind of said this, but, very quietly and hidden, a lot of wealthy people are doing things very differently than we're all taught to do traditionally.
So you got to get yourself that education and that understanding around what it is that them people are doing and the systems that they utilise to be able to put in process the steps to be able to keep building that wealth.
Yeah, yeah, and trying to find people like at the end of the day, net worth don't lie. Find people who have a higher net worth and try and emulate what they're doing, but also one eye on like, did this person make their wealth? Because if they're like a trust fund kid, second, third generation where their parents made the money,
Yeah.
they could be going the opposite trajectory, of course. So don't follow a thing they're doing, of course. Or, but keep that in mind, right? They may be doing the right thing. I'm not gonna discriminate against,
No.
those people, of course. But just I think what we have is an ecosystem of first generation multimillionaires, right? Like a lot of us, we had good paying jobs, but our families were not multimillionaires, right?
Yeah.
But we're the first generation to kind of buck that trend and put that trajectory upward.
Yeah. Bloody oath, mate. And then keep passing that on to our children and our grandchildren, mate, eh?
Yeah, yeah. Hopefully they don't mess it up, right? But
Yeah.
90% of wealth leaves families in 2 to 3 generations is typically the trend.
Yeah. So the key is, I believe, is education. So and teaching them how to handle that money properly.
Right, correct.
Teaching them what the value of a dollar is and how to earn it and what it takes to earn it and then to do the right things with it.
Right, right. But the big difference there is, wealthy people don't trade time for money. You may have to do that to get some down payments on properties or get some money to buy assets like stocks, etc., or start your own business. But as soon as you get that fire going, you got to build systems, build assets so that, that can make more money for you than you could trading your own time for it.
Yeah. Yeah, I've been listening to Robert Kiyosaki for a lot of years, and that's something he speaks about all the time, eh? Like the wealthy don't work for money; they work for assets, eh? Because that's the
Right,
key.
right.
That's the key to building true wealth. And the stuff that he talks about buying a home. Also, a home's not an asset; it's more a liability. Your own home that you live in. So
Right, right. I mean, that's typically, again, it depends on where you are in the wealth elevator, right? Like if you're under a few $1 million net worth, then you probably shouldn't buy a house to live in. But that, of course, that bucks my whole discussion earlier of most people should because they're horrible with their money and they
yeah,
need a forced piggy bank. So if you're listening out there and you save your money pretty well, it may make sense not to get a house to live in and take that and invest it or start your business.
yeah. No, good call, mate. Good call. Well, Lane, love to thank you for your time today, mate. It's been a real pleasure having you on. I hope I can get you back on again someday and we can dig into this a bit deeper, mate, and keep educating. You can keep educating me and my audience.
Yeah, yeah. Thanks for having me, Rodney. Appreciate
Could
it.
you just give us a bit of a plug for yourself, mate, where people can find you and get into your stuff that you got to share, mate?
Oh yeah, they can go on Amazon and if they buy the book and they leave a nice review, they can shoot us a screenshot of it, team@thewealthelevator.com, and we'll hook them up with the free PDF. I know people like to throw that into their chat GPT and ask it questions from there. But we'll also give you the MP3s, so in case they're like me and can't read too well, they can we can read it to them. But yeah, if they like podcasts, check out my podcast. Been doing it since 2016, The Wealth Elevator.
Awesome. Excellent, Lane. Thanks very much, mate, eh?
Cool. Yeah, thanks for having me,
Cheers, mate.
Rodney.
Keep on stacking,
Thank you, man.
fella. Have a good day.
This has been another episode of the Rodney Bull Show, a Rebel Edge production. Please share with your family and friends, and don't forget to like, subscribe, and leave a review.